If you can master this liquidity strategy, you will become a consistently profitable trader. Trade with large institutions and take the guesswork out of your trading. In this video, I'm going to share with you some vital points about institutional liquidity that most people just simply do not know. And it's these critical points that have helped hundreds of our members get funded and bank their first ever profit splits. This video explains how and why institutions are manipulating you, how to mechanically identify liquidity, how to build a mechanical system around this knowledge, how to enter and exit for maximum profit, and finally into a trade breakdown of a trade that I took today with a step-by-step plan. On screen right now, you're seeing the exact trade that I took today, and here is a MT5 screenshot of this specific trade. Let's dive into the lessons and the trade plan so that you can take trades just like this on a daily basis. Okay, so the first thing to understand is how are institutions manipulating you? Okay, so let's take this market right here and let's say that this is a sell bias market. So you can see we have this low in the market, followed by a pullback in price, followed by a lower low in price right here, breaking structure to the downside, indicating that bearish momentum is in control of this market. Imagine there's a big institution, a big entity, or a bigger player in the market that wants to buy $500 billion of this market right here. So what they would do, they would buy 100 billion right here. The market would then start aggressively moving to the upside. Maybe there's another 100 billion in volume right here. And so they can fill another 100 billion of their orders. And then maybe 100 billion right here, in here, in here. And then all of a sudden, this institution, this bigger player, this entity in the market, they have a really awful average price. So, they wanted to get filled right here, but they now have an average price right here. And so institutions need a more effective way in order to position themselves into the market. And so what they're going to do is they're going to take price lower and they're going to run sell stops in the market. So let's say that we have $600 billion worth of sell stops below this low right here. Well, what they're going to do is they're going to take price down. They're going to liquidate below this level right here. And then what they can do is they can match up their $500 billion in buy orders with the $600 billion of sell side liquidity that is resting below this level right here. And so what that allows them to do is it allows them to get filled right here with a great average price. These institutional buy orders can be matched up with these sell orders right here. And then they can get filled where they actually want to get filled. Like, let's say they have an objective and they have a target of like where they want to be filled. Let's say that is like 4228. And so they can get filled at that price and they can be filled effectively in the market. And then now that they've been filled, price will then continue to the upside. But how are they manipulating you? Well, most traders, how they're going to see this market is they're going to see this low, they're going to see these equal lows, but how are institutions manipulating you? Well, most traders, when price gets down here, they're going to see this as sort of like a support level. And so what they're going to be doing is they're going to be looking at buying right here with a stop loss below this quote unquote support level, and then they're going to be looking at targeting a higher price. So what will happen is price comes down, these traders that get long right here thinking the market's going to go higher, they get stopped out. What they're doing is providing sell side liquidity to the bigger players. Not only that, on the flip side of this, you're going to get momentum traders coming into this market as we break and we close below here, and they're going to do something like this. So as we close below, they're going to have a position on the retest or on the closure, they're going to have a stop loss, and they're going to be looking at targeting lower prices. And so what we have is all of this sell side liquidity that's generated from. And so what the institutions are doing right here is engineering liquidity. And what they're also doing is inducing traders into this market. And inducement is just a thing that persuades or leads someone to do something. And in the context of trading, this means literally buy or sell the market. And so it's all of these stop losses and these breakout traders that are induced into this market, which is ultimately what provides the sell side liquidity and fuel for the bigger players, for the institutions to actually move the market in the intended direction. And so as a result, rather than them trying to get filled right here and getting a very poor average price, they can drive price down lower, induce traders short into this market, stop out any early buyers, and then this $500 billion, they can easily get filled down here and they don't even have to affect market price. And then what you're going to be looking at doing is getting positioned somewhere like here, and you're going to need like a mechanical system to do this. And then you're going to be looking at targeting fixed risk to rewards. You're going to be looking at targeting external range liquidity, and you're going to be looking at targeting higher prices. To be honest, none of that actually makes any sense unless you know actually how to identify key liquidity levels. I'm going to share with you ones that you probably don't know about, and I'm going to show you how to identify them in a fully mechanical way. So on my screen right now, you can see 3 different colored boxes. We have the Asia session in red, we have the London session in blue, and we have the New York session in green. And so there's many different levels of liquidity that you could be trading from. Number one is previous sessions highs and lows. So like, let's say you've identified a bullish market regime, you're going to be looking for a liquidation below a previous session low. So in this example, the liquidation was below the London session low, and then you're going to be looking for a continuation higher. If you're trading the London session, you're going to be looking for a liquidation below the Asia session low if you have a bullish bias in the market. And if you have a bearish bias, you're going to be looking for a liquidation above the Asia session high. Something to note here, this is what we classify as external range liquidity. So what you're going to be looking for is, can price take out external range liquidity below a previous session's low? And then what you're going to be looking for is, okay, once we've seen that, we're going to be trading to internal range liquidity. So it's very important to note that price always moves from external range liquidity to internal range liquidity. So what do we know? Well, we know there's going to be a lot of sell stops resting below the London session low. This is also going to induce a lot of traders short into this market, momentum traders thinking that this is a breakout to the downside, and it's going to stop out any early buyers. What you're going to have is people buying right here, thinking that the market's going to go higher, stop loss below the low, they get stopped out, and as a result, they provide sell side liquidity. And on the flip side of that, you're going to have breakout traders right here, shorting on the retest, shorting on the close below, stop above here, induced short into this market, assuming and thinking that the market is going to trade lower. It's very important that you have your own way of defining liquidity in a very mechanical way, so that there's no room for any subjectivity. Other levels of liquidity you can pay attention to is double tops in the market. These can also be referred to as equal lows in the market. And you also have previous day's low and previous day's high. All of these levels are very effective, all of these work, all of these are very objective, but I recommend to you as a trader to pick maybe one or two of these levels, begin with these, develop mechanical frameworks around these liquidity levels, and I encourage you to look at how price reacts around these levels. So we've looked at previous session highs and lows, we've looked at equal highs and lows, and we've looked at previous day high and low. These are three mechanical ways in order to identify liquidity in the market. Okay, so let's say that we've got a downtrending market and then we get a pullback, we get highs, we get lows, etc., etc. And let's say price is like right here. And let's say this is like your Asia session range right here. And so what do we have? Well, we have a low in the market, followed by a pullback, followed by a lower high, followed by a lower low in the market. So we have a clear downtrending market. And this is where institutions engineer liquidity. So if you're sell buyers in the market, what you're going to be looking for is a liquidation above the Asia session high. And as we know, this is going to induce a lot of traders long into this market. This is going to induce breakout traders thinking that the market's going to go higher, and this is going to stop out any early sellers. So this is what provides the buy side liquidity. And as we know, this is what institutions need. They need equal and opposite liquidity in order to actually execute in the market. So number one is you could wait for a retracement candle. This is like literally waiting for 15-minute bearish pressure coming into this market, indicating to you as a trader that sellers are actually taking control of this market. And then what you could do is you could enter on the break of the low, invalidation above the liquidation, and then you can look at targeting lower prices. So this is entry model number one. Entry model number two would be like, okay, I'm going to drop down to the smaller time frame. I'm going to look for a market structure shift, right? Because we've got a high, we've got a higher low, followed by a higher high. Then what we get is a change of character right here, breaking structure to the downside. And this could be on like the 1 minute, 3 minute, 5 minute time frame. Then you're going to look for a pullback, maybe back to like a demand zone. Then you're going to look for a pullback into a fair value gap, an order block, an inverse fair value gap. And then you're going to look at shorting this market to the downside. So this would be entry model number two, or entry model number three would be the most conservative approach. So this would be where you're waiting for the structure to shift on the 15-minute time frame. So this is your 15-minute low right here, which created the liquidation. And so what you would be waiting for is this macro shift. So you're waiting for price to come down, break below. We get a change of character on the 15-minute time frame. And then you're going to be looking for a pullback, maybe into discount. Maybe you're looking on a Fibonacci retracement back into discount, 61.8, 72% retracement, looking for that OTE. And then you look at shorting this to the market. The problem with this one is that you don't always get this retracement. You're not always going to get price coming back into discount and sort of giving you that second opportunity. And you need to make sure that everything is as systematic as possible when you're testing your system. One thing that is like super crucial to note is like your executions. They need to be during a London kill zone or New York kill zone. So this is going to be between 3 and 5 a.m. Eastern. This is the London kill zone. Or you're going to be executing between 8 and 10:30 a.m. Eastern, which is the New York kill zone. So all of this theoretical stuff is well and good, but you need to have specific windows of execution. You need to make this mechanical. You need to know exactly when you're entering in the market, and you need to know what you're doing outside of these windows as well. Okay, so the first thing of the trade plan is like, what is my daily directional bias? Like, am I bullish? Am I bearish? Do I have no bias? Like, what am I actually looking for in this market? And I have a very mechanical and I have a very systematic way of doing this. So as you can see right here, we have the 50, the 100, the 200 exponential moving average. So when the 50 is greater than the 100, which is greater than the 200 EMA on the 15-minute time frame, this indicates a bullish market regime, and this indicates pro-trend market conditions. If I want to trade with the trend, I want to have a bullish bias and I want to be looking at buying this market. And then the next thing that you need to ask yourself is, okay, I'm turning up to the New York session. Where is the sell side liquidity resting? So you always need to be asking yourself, where are buyers? Where are sellers? Like, who's in control of this market? And where is the liquidity resting? So as we know right here, based on what I've just taught you before, we have sell side liquidity resting below the London session low. So we know that there's going to be a lot of sell stops below here. We know that this is going to induce a lot of traders into the market if price does come down and liquidate below this level. So think about it like this, right? If you're bullish in the market and you want to see higher prices, you need to see price come lower before we can trade higher. Like, think about it like this. Like, you need to ensure that you're getting a discount in the market and you're getting a fair value for this price. And so that is exactly what we get right here. We know that we have sell side liquidity below the London low. We also know that we have sell side liquidity below the Asia low. And so we're starting to see the liquidation. Because think about the bigger players, right? Think about the bigger picture. Anybody that wants to get long in this market, they cannot get long here. The bigger players, the institutions, they can't get long here. They need to engineer that liquidity. How do they do that? They induce traders short into this market via breakout traders, via momentum traders, thinking that the market's going to go lower, and they're going to stop out any early buyers, right? If you're long in the London session, right? Well, you're going to have a stop loss below the London session low. Oh, well, you've just been stopped out. And this is what provides the sell side liquidity, which is what the institutions need, right? They need equal and opposite liquidity in order to actually position themselves into the market. And it's at this stage right here where you can either drop down to the smaller time frame. You're going to look at the smaller time frame like this, where you've got a low in the market, followed by a lower high, followed by a lower low. You're going to need to see a change of character, breaking structure to the upside, and then you can look at getting long in this market, right? This would be if you're looking at the smaller time frame, the 1 minute, the 3 minute, the 5 minute, or you can stay on the 15 minute and you can look at retracement candles. So let me just break down exactly what that looks like right here. So we've seen the liquidation. We then need to fast forward to the start of the New York kill zone. So this is the start of the New York kill zone right here. And the reason that we do that is because the executions have to come within the kill zone windows. So you can see right here, this is the first candle of the kill zone. This closed at 8:15 a.m. Eastern. And as you zoom in, you can see we're starting to get this sort of V-shaped recovery. This is very good to see. And so if you're entering using a retracement entry model, this is how I personally entered this trade, was on the break of this 15-minute bullish candle high. And this was via a buy stop in the market. So my buy stop went on the break of this high. My invalidation always goes below the liquidation. And these are things that you need to test, right? If you're developing or building a mechanical trading system, where is your invalidation going to be? Are you going to put it at the low of the manipulation? Are you going to put it below the confirmation? Are you going to put it in the middle? Where are you going to put it, right? These are all things that you need to be asking yourself. And then for me, I targeted a fixed mechanical 1 to 2 risk to reward, which takes all of the guesswork out of your trading, right? You could easily go back over here on the daily time frame and look at these highs or the areas of liquidity. What I recommend for beginners is just to target a fixed repeatable 1 to 2, 1 to 3 risk to reward. It means that your data is going to be very reliable. It's very simple. It's very easy. And it takes all of the guesswork out of your trading. And so I was tagged short on this trade right here. And just for anybody thinking that I'm cherry picking this trade, which to be honest is a fair assumption, here is the analysis that was sent ahead of time to the community, and here was the exact execution of this trade. And then it's up to the market to do the heavy lifting. And as you can see, this trade did hit take profit for a 1 to 2 risk to reward. And as well, I encourage you to not micromanage. So whenever you're using like a fixed risk to reward, don't go break even, just allow the trades to play out. Either you're going to get two outcomes, right? You're either going to have a take profit hit or you're going to have a stop loss hit, and there's no in between. So often where a lot of traders go wrong is they're going to get in this trade right here, might get very close to your take profit, maybe not actually touch the take profit, and then all of a sudden you're like back to entry. A lot of traders would have went break even, they would have got stopped out at break even, and then they miss out on the actual move of the day. Also, traders may have got emotional right here. They may have micromanaged, they may have closed early on this big bearish candle right here. So it's important to adopt that sort of mechanical algorithmic mindset, and that's going to really help you as a trader. Right? Apart from this, like, you need to know like what is going to be your A plus trade. This is a very simple mechanical framework that you can instantly implement in the market. What you also need to ask yourself is like, how do I filter for A plus trades? How do I invalidate trades? How do I be selective with my trades? And it's making all of this mechanical that is extremely important to you. Because at the end of the day, you can't just take every liquidation. You can't just take every manipulation. You need that mechanical framework in order to work out how do we do this. And that is exactly what I do inside my exclusive community and my one-on-one mentorship. Let me just summarize everything that we've covered today. Number one, you learned how institutions are manipulating you. They do this via inducing you into the market and getting you on the wrong side of the market. This is what provides the liquidity and fuel, because they can now match up their institutional buy orders and they have enough equal and opposite liquidity on the other side of the trade so that they can position themselves into this market effectively. As a result, they don't affect their average price and they get positioned into the market without having much effect in the market. A lot of the time, traders don't even know this is happening behind the scenes. You learned multiple entry models. We have retracement candles. We have lower time frame change of characters. We have macro change of characters. And I gave you 3 different potential entry models that you could implement into the market. I showed you using a retracement entry model where we can enter on the break of the high and where to place your stop loss. So stop loss always goes below the manipulation, below the liquidation. And I give you multiple exit strategies. You can target external range liquidity. You can target fixed risk to rewards. You could even trail your stop with the market. At the end of the day, a lot of this is down to you to put this together into a mechanical rules-based system to make your life very easy in the markets. As always, thank you so much for your time and support. Take care. Bye bye.